started with the Fed raising interest rates, and it's not just the amount that it's been raised, it's the speed of it, right? And I think everybody is kind of all eyes on the Fed right now. There's a saying, don't fight the Fed. Just how have you read, what they've said recently? What do you think? Are they really going to hike again? And then kind of from that lead into your thoughts on inflation, deflation, what's going on in that part of in the yields world.
So it's a good question. And there's a lot of debate around what's the real cause of inflation. And in principle, there's really only one real cause, and that's money printing and excessive growth and output, right? But you could also make the distinction between principal causes and proximate causes, right? So proximate causes are just sort of closer to the end state. And so I always hate to say something like income-driven or wage-driven inflation, because it sounds like I am blaming workers for demanding faster wages. That's not really the case. It's always a result of poor monetary and fiscal policy that workers are forced to do so, and that it results in inflation. So you could say that wage or income growth is the proximate cause, but not the principal cause. So with that out of the way, I think it's important to make a distinction between the different proximate drivers of inflation and how they change over the course of an inflation cycle. So, in 2021, the primary driver of inflation was really fiscal transfers and supply chain issues that were causing goods inflation. And durable goods inflation and non-durable goods inflation at certain points were running 15, 20%, really, really fast, right? As a result of that, though, workers began to expect faster inflation in the future and negotiate for higher wages. And even as those supply chain issues resolve, wage-driven, sticky core services oriented inflation remains high. And that's really driven by income and wages. And you don't have to take my word for it. If you look at the correlation between the Atlanta Fed wage growth tracker and CPI services less energy, you see almost a 90% correlation going back over the last 20 or 25 years or so, right? And so we've seen a transition and the driver of this inflation from supply chain issues and fiscal transfers into incomes, right? So what is the Fed looking at? And the Fed understands this. This is a dynamic that they've talked about before. What is the Fed looking at when they think about, an income-driven inflation cycle? Really what they're looking at, they are looking at the reported inflation data. They are looking at CPI and PCE and core and services and so on and so forth. But they're also looking at consumption and income, right? And so what's driving faster inflation or stickier above target inflation? It's consumption growth in excess of production growth. What's driving that consumption growth? It's income growth, like we said a second ago. And if you look at the most recent income data, really the best line item from the report from the BEA is disbursements of wages and salaries. And that's because that's where the preponderance of income comes for most people. It's growing at around 6.5%. Actually, I think it's 6% year over year. And if you look at the 3-month annualized rate of change, which is sort of a shorter term gauge of momentum, it's comping at 6.5%. So it's not really showing any indication of slowing down. So while we have seen some relief even in core and core services over the last couple months, 2 or 3 months, call it, even though it's still above trend, the driver of that sticky inflation is not really budging. And that's what the Fed is going to be focused on. And so candidly at Invictus, we probably expect another 25 basis point hike, and we expect continued quantitative tightening. Eventually, and the reason that the Fed is going to continue to have a stance of hawkishness and tight policy is because the risk of this disinflationary impulse from energy and from goods and durable goods, when that disappears, you're going to see inflation start to gravitate more toward that wage-driven number, which is right now around 4.5%, right, if you adjust for productivity. So until that dynamic starts to ease a little bit, I think that there's a very high bar for the Fed to take its foot off of the gas.